Hey everybody, this is my first video blog that I plan on doing, taking into account all the data that is readily available, I must admit, for people to understand what is currently happening in the money situation in the world. What we are currently looking at right now is the money supply from 1959 to May 2006. And up to 2006, at the time, the bank was Federal Reserve. Sorry, I'll refer to bank quite a bit, but I'll make sure that everyone knows that is the Federal Reserve that I'm talking about. They held roughly $800 trillion or $1 billion in their bank accounts at the time before the financial crisis. Now, this doesn't have anything to do with the fact that the American government has to still pay back the loan that they've accumulated. However, this is just more of treasury notes that had been injected into the American economy prior to 2008. And during 2008, when the economic crisis took place, the Federal Reserve injected QE1, which was roughly $800 billion. Now, when we look at the fractional reserve banking that banks use from a 9-to-1 ratio, which is a minimum, to up to 30-to-1 ratio, which banks were using during the up to the 2008 crisis and housing bubble, of course, it created a large amount of money. Okay, and since then, QE2 has come into place, another $600 billion, which is pretty much doubling the ability for banks to lend out even more money. But the one thing that is also not attributed is that just last week, Bloomberg had filed, well, they filed a court order many months ago, or actually I think it was last year when they filed the court order to reveal what was their lending practices, and the Supreme Court of America required that the Federal Reserve release that information. There was roughly 25,000 pages, but immediately through that, it was identified that JP Morgan had acquired $3.5 trillion from the Federal Reserve to avoid bankruptcy, and it was an emergency fund. Now, with this emergency fund, it doesn't allow it doesn't require that JP Morgan pay interest back, or interest at a very low rate. With that being said, and with fractional reserve banking, when you do the simple mathematical equation from a 9-to-1 ratio, that's the low end of the scale, it results in a very large amount of supply of money that they are able to lend out in practices to increase the money supply in everyday expenses. Now, with that being said, we're going to take a look at gold so people can understand the gold chart and understand when the increase in money supply happens, what happens with commodities and why they hold their value. When you increase the money supply, it results in the fact that prices will be bid up. And Peter Schiff on the weekend in his video blog gave a perfect example of having a few people go to an auction and they're only allowed to bring $100. And then he has the same example and people are allowed to bring $1,000. Well, what's going to happen? You're going to see an rise in price, and that's exactly what happens. Now, I just want to make clear the whole reason for me developing these videos is so that an individual on YouTube, and I cannot say his name because for the most purpose of it, because I probably wouldn't be able to continue to make these videos, but it's actually kind of funny how that is set up. But anyway, I don't think he understands that the underlying issue of the economy is the creation of money. When you look back to 1910, 5 cents now today is worth over $23. And that's actually a little bit skewed because it's actually even higher than that. And I cannot attribute to the exact value for that, but that's okay. It's not a big deal. What I'm trying to get at, though, is the value of the dollar has decreased. And with that being said, just over the past 10 years, for say, from the time that the stock bubble was taking place and the Federal Reserve decided to lower interest rates and inject money into the economy, gold has almost gone up $1,000 in under 10 years. That's the highest peak it's ever gone up. And do you want to know why? It's because the money supply at that time, or prior to that time, had not increased. The Federal Reserve had not got into the point of creating money out of thin air. And what we are currently seeing is the Federal Reserve continue to do this. Now, there was a blip in the 1980s when gold retreated a little bit, and this was due to the increase in interest rates. However, back when we look at the graph in the 1980s, the money supply at that point hadn't really changed. And the increase in interest rate caused gold prices to go down. But what we are seeing now is an increase of over 120% of money injected into the economy. And if you were to raise interest rates to a certain point, what's going to happen? Well, it's going to pretty much it'd come to the point where the American government would have to pretty much take everyone's income to pay the debt. And with that, what are we going to see? Well, we're going to start to see prices rise even further. and cause a tremendous amount of trouble. This topic goes even further than an everyday analysis of the markets. I mean, when we look at the creation of the Federal Reserve in 1913 and how the legislation got brought into play over Christmas break when everyone was at the legislature, go figure, that it created this environment for the Federal Reserve to control the money. Now, some could argue that it's better that it's not government and allowing the corporate or the bank to oversee and ensure that the money supply isn't taken out of whack. But the one thing on top of that is that the Federal Reserve has no ties whatsoever in the fact that it's a private business. It is a private business trying to make profit. So, of course, when Tim Geithner comes into the position, the American government goes into massive debts, larger than any before. And why is that? He was the chairman of the New York Federal Reserve before taking office. So what does that tell you? And I can guarantee you when he gets out of office, he's going to go back and work for the Federal Reserve. And if he doesn't, it's going to be because he gets a very large payout. Now, I can't back that up with facts, but it's pretty much common sense, if you ask me. Anyway, everybody, I hope everyone understands that basic explanation of my thoughts on the market and what has happened over the past 100 years and the analysis of the past since the early 70s, the increase in money supply and the reflection of gold prices and how it is affecting the value of the dollar.